Hello, I'm Larry Pond, and the presentation I'm giving you today is IRS Audits, How to Beat Them. Now, this is for the 2023 San Francisco Pharma SUG participants. You were in other sessions, so you didn't come to my session live today, so I'm recording this for you so you can benefit from what I have to say. So let's get started. So first of all, a little bit about me. I'm a CPA, a PFS, a CFP, an EA, a USTCP, and an AEP here in River Shores, California. I've been in practice since 1986, and I really enjoy talking about tax to tax professionals, financial advisors, and the general public. I also teach income tax at the College of San Mateo. I received my bachelor's in business administration from UC Berkeley with an emphasis in accounting and finance, and my master's in taxation from Golden Gate University here in California, in San Francisco. So we're going to talk about IRS audits today. If you're a freelancer or an independent contractor, your odds of an audit are much higher than someone who's an employee or working for a W-2. So your odds of an audit are higher, but there are things we can do to minimize the chances of the IRS challenging your tax return. Now, it's just not the IRS audits to consider. There's also state audits to consider too. And especially as a freelancer, if you're, I'm here in California, if you're working outside the state of California and you never step foot in California, but you have clients in California. Here in California, we have a lot of pharma companies, right? They're centered here around the Bay Area, the San Francisco Bay Area, or the San Diego area. So you might have some clients in these locations in the state of California. Even though you haven't stepped foot in California, you may be owing taxes in California because you earned income from California. So make sure your tax professional is aware of those rules. And there's been a lot of recent cases about them. The most recent case that was quite interesting was a tax preparer located in Washington State. But she had many clients in California. And she didn't report those clients' income on her California tax return. She did not file a California non-resident return, but the state of California knew about her income earned in California. Well, California changed the law back in 2013. And so she was operating under the assumption of what the rules were before 2013. And she was assessed some penalties. And she was trying to argue that she shouldn't be assessed penalties because she didn't know the law changed. Well, the state said ignorance of the law is not a defense. Those penalties still apply. So it's important to understand the tax law, federal law, or state law. Well, let's talk about IRS audits. What are they? Well, the IRS might question or adjust your tax return. And this could happen if you have a balance due. You filed your tax return, you owe some money, and the IRS will send you a letter saying, oh, you owe us some money. You paid something, but not enough. And it'll give you a heads up what you owe and what the amount is if you pay by a certain date. So they might calculate some interest and penalty for you. So you might get a letter if you owe money to the IRS, and it might come on a regular basis, not like a credit card statement. So don't expect it to come like a credit card statement. But if you do owe money to the IRS, you can call the number in the upper right-hand corner of that letter to negotiate a payment plan. You agree to have a certain amount paid per month. If you have it taken out of your bank account, it's a lot easier, and the likelihood of acceptance by the IRS is easier. But of course, the whole goal is to get your taxes paid and to reduce the amount of interest and penalties that you pay. Or you might get a letter that says that you're due a larger or a smaller refund. Maybe you claim more for estimated payments than you really paid, or you claim less. There could be a difference. You might get a letter saying your refund's bigger than what you claim, or it could be less. Or they have a question about your tax return. There's a reason why there's questions on your tax return. Make sure you answer them. Don't leave them blank. If you leave them blank, the IRS might send you a letter with questions in your tax return that could delay processing. So you don't want that to happen. So answer all the questions. Use the right forms. If you use the wrong form that's not appropriate for your tax situation, that will certainly create a problem. Or the IRS wants to verify your identity before they give you a refund. They want to make sure it's really you who's filing the tax returns. They want to verify your identity. They might ask you for a copy of your driver's license, a copy of your passport, or whatever documentation. Or you can stop by an IRS office in your local area to verify your identity. You show up and say, hi, here's who I am. Here's my identifying paperwork. Or the IRS needs additional information. You might have a situation in your tax return, or you might have not answered some questions, or the numbers just don't look right, or the numbers didn't flow from one form or the other. Or the IRS changes your tax return, and that could happen too. Like you claim certain children in your tax return. What if someone else claimed them? Also, that can create a problem. Or the IRS needs to notify you of delays in processing the tax return. We've seen that happen in the last few years quite a bit, especially if you file on paper. So it's always better to file electronically. Everything will get processed a lot more efficiently instead of filing on paper. It's going to take longer to file on paper. It might not be as accurate, so watch out for that. So what kind of letters can you get from the IRS? So you might get what's called an adjustment letter. In the upper right corner, you might see something that says CP 2000. So CP 2000 is a letter from the IRS that says, there's some information you left off your tax return, because they get those 1099s from all your payers. If you're a freelancer, just keep track of all your income. Don't just wait for the 1099. Sometimes your client might send you a 1099, or they might issue a 1099, but you never got it. Maybe because you moved, give them an incorrect address, or they made a typo, you didn't get it. So for your own personal record keeping, you got to report all your income, not just the ones where you get 1099s. That's a big mistake a lot of people make. They said, oh, I'm only reporting 1099s. No, you made more money than that. Your payers might not issue a 1099. For example, if you have an overseas client, they could be in Sweden, Denmark, or Norway, or Finland, or whatever, overseas, they don't send 1099s. You might not get 1099 if you have an overseas client. But the IRS will send a CP 2000 if you forgot to report a 1099. If you had an investment account you forgot to report, or your spouse forgot to tell you about, or a bank account that paid some interest. Interest rates are getting higher now, so there's a good chance the bank will pay you a little more interest. You'll get a 1099 from the bank. Very common. Or sometimes just something just didn't match. You might have made a typo. You might have some dividends from an investment account, and it was $12,000 of dividends, but you entered $1,200. That happens, right? You made a typo. You left off a zero or something like that. That's a CP 2000 letter. Make sure we respond in a timely manner, and make it easy to follow. Make it easy to understand. Your tax professional should know how to efficiently respond to a CP 2000. A correspondence audit are very common. That would be an audit where the IRS has specific questions on your tax return, and they want you to provide backup for it. The most common would be charitable deductions. They'll say, oh, you claim $32,000 in charitable deductions. Can you give us some proof for that? Canceled checks, thank you letters. If you gave non-cash contributions like used clothes or something like that, did you follow the rules? Did you file Form 8283 if there were more than $500? If it was more than $5,000, did you follow the rules there? Where the charity would have to sign the Form 8283. You might need to get an appraisal, a qualified appraisal, if you're donating non-cash items, or if you're just donating stock. If you're donating stock, you won't need an appraisal, but that goes on the 8283. So it's important to do that. That's very common. Another very common correspondence audit are mortgage interest deductions. Because the IRS or the Congress has changed the rules on deductions for mortgages. Have you reported the correct amounts? Are you claiming too much? So that's very important. Correspondence audits generally tend to be one item on your tax return in general. In general, it's one item. It's unlikely they'll go through the entire tax return. And then you have what's called an in-person audit. And that could be what's called an office audit, which means you go to the IRS office and bring the backup information and proof of the numbers and answer their questions. Or it could be what's called a field audit. Generally, I don't recommend they come to your home or come to your business. If they want to come to your business, you can say that's being disruptive. No, have them come to my office, your representative's office. Less distraction, better control. So let me give you an example of a bad example of a field audit. It was a business, and the IRS insisted on meeting at the business's office. So they met at the conference room. Well, they were going over the questions and all that, and the IRS and the owner said, I'm getting tired. I need to take a break. I need to take a restroom break. I need to get some coffee or something like that. Well, during that break, the wife of the owner went to the front desk and asked her, where was the restroom? Well, they've been at this location for over 20 years. And the wife was getting a W-2 from this business in excess of $250,000. So she had a W-2 of $250,000. She was getting retirement plan contributions. She was getting all the fringe benefits of being an employee and all those sorts of things. A $250,000 salary. Well, the IRS agent overheard her asking the receptionist, where's the restroom? Obviously, she's never been there in 20 years. So he had to question her, what do you do for the company to pay you $250,000? So in that case, the IRS disallowed the wage deductions because she wasn't really working for the company. That was more of a dividend, which is non-deductible by the corporation. So, so there are reasons why we really don't want the IRS to visit the business. It could be disruptive. It could be distracting. So we got to watch out for that. But those are the types of situations we have. So recently, we had this movie, Everything Everywhere at Once. Here's Jamie Lee Curtis playing the IRS agent. And, the IRS office kind of looks like this. They're in cubicles. All the IRS agents are called revenue agents. Revenue agents, those ones who do the exam, or they can be called TCOs, tax compliance officers. And you see her messy desk here with all the receipts and all that. So frankly, we wouldn't deluge the IRS agent with receipts and expect her to add them up. You can see her adding machine there, adding them up. No, we add them up. We would put a rubber band around it, put a tape on it. We do a spreadsheet that'll summarize the numbers on one sheet of paper. We want to make the IRS agent's job as easy as possible. Don't make it difficult for them. They're human beings too. And here's Jamie Lee Curtis playing that character. Here's another thing I don't recommend. Don't bring the whole family. Don't bring grandpa. Don't bring your daughter. Well, actually, don't come to the meeting. Have us represent us because we do this for a living. We know how to do this efficiently. I've been in the IRS office. I can overhear in the cubicle next to me where the agent's dealing with the taxpayer, and I feel sorry for the agent. They're answering questions that weren't asked. They were giving unhelpful answers, and it could be a bit frustrating. It could be a bit difficult. So as professionals, we can save you a lot of time and money. Our fees are well worth it because we can get in and out of there, in some cases, in an hour or less, versus spending the whole day there. Now, when you make an appointment with the IRS, they will tell you this is a 4-hour meeting or an 8-hour meeting or whatever. But my goal is to keep it as short as possible. Keep it as short as possible because the agents are human beings too. They got to get home to their families and deal with those things. So everything everywhere at once. Yeah, in your typical IRS office, there's no portal to the multiverse and those kind of things. So it was an entertaining movie, but that was the background or the backdrop of the story was Michelle Yeoh's character. Her business was getting audited. But anyway, we'll go over the details about that. So when you do get a notice from the IRS, read the letter carefully, respond by the specific date. There's a date, because if you don't respond by the date, they'll close the matter. It'll move on to the next step in the process. If it's an adjustment letter, they'll assume that you've accepted the adjustment. If there's additional income you didn't report, they'll assume that you don't have a disagreement. They will add that income to your taxable income and calculate the taxes. So respond by the specific date. This will minimize the additional interest and penalty. Also, if you ignore the IRS, you start losing your rights. So by responding on time, you preserve your appeal rights if you do not agree. And now, just recently, the IRS has a new IRS documentation upload tool where you can answer the IRS notice on the IRS website by uploading documents. It works a lot more conveniently than having to mail the information in. So you can upload it with this documentation tool. It's not for all notices yet. It's a handful of notices, and I think the list will grow over time. Provide the requested information in the letter. Answer the questions that they ask. Don't answer questions they didn't ask. Only answer the questions they ask. A little bit about my background. I did work for the IRS when I was 20 years old. I was that young man. I was 20 years old. I was that young man that answered those letters that taxpayers sent in. It was easy for me to understand. It's in at least 14-point type. It was really clear on the response. They were answering the questions that are being asked in the letter. They provide the documentation. It got processed. It worked out really well. Now, if you send in 50 pages, 10-point type, and 10 pages of one sentence, if you make a political rant or you complain or say it's unfair or whatever, it's going to take longer to get processed. So make it as easy as possible. So per the IRS, this is the IRS's statement about examinations. Let's read this together. An IRS audit is a review/examination of an organization's or individual's accounts and financial information to ensure information is reported correctly according to the tax laws and to verify the reported amount of tax is correct. The small business self-employed examination employees are to ensure consistent application of policy, procedures, and tax law to effect tax administration while protecting taxpayers' rights. So these are directives that the IRS employees have to follow. So your initial contacts, you'll get a letter from the IRS. IRS letter 2205 says your return has been selected to be examined. And there's different types of audits. It could be just a specific schedule, specific numbers, or specific issues. Sometimes the IRS picks issues to audit. Sometimes it could be a home office. It could be automobile expenses. It could be business gifts or whatever they decide to audit that year, or the industry. Sometimes they'll say, we're going to audit realtors, or we're going to audit lawyers, or we're going to audit mortgage brokers. Whatever your job is, they might just audit that class because they'll train the agents on what to look for certain types of professions. Or you're a consultant, you're a software consultant. So you'll get a letter saying it's been selected. One expectation I need to set with you is that no, we can't get the IRS to drop it. We can't say, no, you can't audit me, you shouldn't audit me. No, you're going to have to schedule the appointment, hold the appointment within 25 to 35 calendar days of the first action of the case. So the IRS employee has to keep this thing moving. They don't like delays. The managers don't like delays. And then after you make the appointment, you talk to the IRS, give them some background information, figure out what your situation is so they know what they're looking at. They're going to send you an information document request, also known as the IDR. That's Form 4564-IDR. It's a list of information they're going to look for. And it's very specific. It can't be too vague or non-specific. If you think it is, they're saying your bank accounts from the date you got married or whatever, right? It's got to be specific. It's like your bank accounts from January 1st of 2021 to December 31st of 2022 or something like that. Something very specific, easy to follow. Now, if it's vague or non-specific, you can request a modification, and that's sometimes what we do. Sometimes the IRS might have a 10-page IDR. We can probably talk to them as professionals, as experienced professionals, and say, you don't need that, you don't need this, you don't need this, you don't need this. Maybe get it down to 2 pages instead of 10 pages. So we need to prove that it's not necessary for a proper examination. It's like, this information is not going to help you, but it's going to be real difficult to get. Time and place of the exam, like the example I gave you about the audit that's at the business location, where the wife went to the receptionist, asked her where the restroom is. Well, during the pandemic, all the appointments were teleconferences, were done over the phone. Some cases, it could be done over the phone pretty easily. In some cases, it could be quite difficult. So you have to judge to see if we should do this over the phone, do it over Zoom. IRS is doing exams over the Zoom. And it depends on the case. In cases where you have boxes and boxes and boxes of documents, you probably want to do that live. That doesn't go well. If you have voluminous information, it doesn't go well virtually. My recommendation is meet at the representative's office. Someone like me, come to my office, not at the business location. Prefer not the taxpayer's home or office. You're not at home, you might have kids running around, and that could be a bit distracting. Or your business. Taxpayer states in writing that the examination would unduly disrupt business operations or force it to close. And you don't want your customers to see you being audited. That's not good. Who's that person there? Oh, it's an IRS agent. Ooh, why don't I want to do business with that person? So we don't want to do that. We want to avoid rescheduling appointments because the calendars are pretty tight. Your calendar's tight, my calendar's tight, the IRS agent's calendar's tight. So rescheduling can be very disruptive, and never no-show. Nothing annoys an IRS agent more than a no-show. And I've had frustrated agents where the representative was a no-show or the taxpayer was a no-show. I make sure I show up. I make sure I show up 10 minutes early. And if I can get them out of the office earlier, that's even better. Make their life easier because they're human beings too. Timely actions. Set expectations regarding timely actions and assistance if encountering problems. The IRS is reasonable too. They're not going to say, provide all this information by tomorrow. No, we need more time than that. Okay, I'll give you 3 weeks or 6 weeks or whatever, a reasonable amount of time. And if you run into a problem, like let's say we're going to give you till the 5th of June. Well, we're trying our best to get this information or gather, and we're having a roadblock because of certain situations. We might have a flood, or we had a hurricane, or something happened. Well, if you run into trouble, let the IRS know. Unfortunately, one of my friends is also a CPA and a representative, and his office caught fire. It was burned down. And I saw it in the news. The ground floor of his building was a restaurant, and I guess they had a kitchen fire or something like that. And the news mentioned that on the floor above was an accountant's office. Well, I didn't realize that was him. And he was in the middle of an audit for a client. He had all the client's records in his office. Well, they got burned and destroyed. And fortunately, he's an experienced tax professional. And so he has a good rapport, good experience with the IRS. And so they know that he doesn't, he's not careless. He's very careful. And they have a positive experience with him. He's credible. So they just took his word for it. He says, oh, did you have that? And he goes, yeah, I did. I really did. And I was going to give it to you. All the boxes were destroyed. And actually, that audit went pretty well. So your reputation is very important. So don't hire someone with a bad reputation. The IRS knows who the bad tax professionals are, and they'll give it a harder time for them. Make sure the representative understands the Internal Revenue Manual provisions. The Internal Revenue Manual is the guidance that the IRS agents get. So we have, as professionals, we have copy of the IRS manual, so we know exactly what they're looking for. We know exactly what their work program is. That way, since we know, we can easily have those questions answered before they even ask them. The easier you make their job, the better it will go. And problem solving, what kind of problems we have, and if we figure out ways around it. Inspections and probes. The IRS agent is entitled to insist of an inspection of taxpayers' business premises and interior of the client's residence. Is a business tour really required? So I try to keep these visits as minimal as possible, but sometimes I'm forced to play Larry the Realtor, tell the clients to leave the house, I'll stay in the house and I'll show the IRS agent where the home office is located and the overall condition of the house. So, but I try to avoid that as possible by getting floor plans, by taking pictures of the house, showing the measurements of the square footage and those sorts of things. And that's been helpful in avoiding an actual inspection. So better documentation, the better. But you've got to make sure that the pictures look good. I tell my client, sit in front of your computer, turn around, put on your glasses, you look so businesslike. And then we take a picture of you in this direction, take a picture of you in that direction. And look, the home office is an office. There's nothing personal. There's no bed in the room. There's no bed, no crib, anything that's personal related. And the IRS will ask about that. They'll ask about that. So for example, I had an interior designer. So I told her, lay out your designs on the table. That was in her dining room. Spread out her designs, and on the other table, have samples of your work, pictures of designs you've done. And the interesting thing is the agent, the first question she had was, "Oh, what's that TV in the corner?" Well, I said, that's how she shows her clients what the designs and the renderings are looking like, this big screen TV. It's not for watching sports. So it's in her home office. So that was not a problem. Per the Internal Revenue Manual, inspection of the interior of the home is not required. So we don't want to disrupt the business operations or interfere with taxpayers' interaction with customers. Sometimes they have to. Yeah, think about a restaurant, right? Do you really want an IRS agent to be in your restaurant, especially during your lunch service or your dinner service? Or what if you're an auto repair shop? That doesn't look good with an IRS agent walking around. It's dangerous, right? They can't walk to where you're working on the cars. So pictures are very helpful. Now it's so much easier. So consideration should be given to the cost effectiveness and practicality of conducting a tour. Yeah, if we could just show you pictures, or what's nice is if you have a virtual tour from a realtor, that's great. I mean, instead of walking through the house, you can take the mouse and walk to the left, walk to the right, go to the kitchen. So video, photo tours, floor plans. So try to keep it as easy as possible. Reasonable determinations. Does the taxpayer have substantiation for deductions? I mean, okay, there's a bunch of numbers in your tax return. Do you have backup for each of those numbers on your tax return? If they're auditing your Schedule C, those are your business expenses. Do you have substantiation for it? If you have a Schedule E, your rental property, you have substantiation for your rental expenses. As a reminder, as a taxpayer, you have the burden of proof, not the IRS. You have the burden of proof. So keep track of your records. So record keeping is very important. So in terms of how do you keep track of your receipts? Are you using an accounting system such as QuickBooks or something like that? So, good record keeping is important. Do the numbers reconcile? Do you reconcile your bank statement? You should, your business bank statement. Or if you're using credit cards, you have one credit card for business and one credit for personal. So keep them separate. And all the credit card companies nowadays, at the end of the year, you can get a year-end statement. And I found that very helpful. Look at the year-end statement to see a summary of what the expenses are, and they try their best to do the categorizations, but it's helpful. It's helpful. Are you close? Close approximation. That's okay. Well, you might not have everything to the penny, but close enough will be good. The reasonableness of the expenditures, we kind of know what costs look like, right? We know how much it costs to run a business. We know how much it costs to run a car. We know what's reasonable for the amount of mileage people to drive or so. So if they're giving a number that doesn't make sense, you as the tax professional will have to exercise some due diligence. Reliability and accuracy of the taxpayer's records, general credibility of the taxpayer's statement in light of the entire record of the case. Yeah, if you're credible, then that's going to be really helpful. If you're not credible, if you answer the first 5 questions wrong and you don't have proof for them, you're not going to have much credibility in the IRS, and therefore they're not going to believe anything you say. So you have to be credible. That's very important. Now, what if they have to impose penalties? Well, there's the negligence penalty. Negligence. They might say you're negligent in your record keeping, you're negligent in your reporting. So audit indicators of negligence, recognizing non-compliance. You're not following the rules. And the decision to assert penalties must have a legal basis in the Internal Revenue Code. So when you do get assessed a penalty, the IRS say here's the penalty under this code section. This is the penalty. There's a plethora of penalties. There's a lot of penalties. Late payment penalty, late filing penalty, accuracy related penalty. And we'll talk about fraud in a second here. Taxpayers have the right to challenge the examiner's conclusion. If you don't agree, you can challenge it. Now, the worst thing is negligence. Negligence. If you get a negligence penalty, that can be very expensive. You have a history of non-compliance. You have failure to keep adequate books and records, inadequate internal controls for processing and reporting business transactions. This is why it's so important that you have a good accounting and tax professional to help you stay on top of all these things. You have a great accounting system. It should be pretty easy and easy to get. It's important for you to know anyway, how are you doing? Are you doing better than last year? What kind of money do you expect to have at the end of the year? What are your taxes going to be? Well, how much you got to put into my retirement plan? All of these rely upon a good accounting system. Or if you have unreported or understated income, there are some former clients. They only report the amount that gets reported on credit cards or the amount that's reported on checks, but they leave out the cash. You can't do that. You have to report all your income. So if there's unreported or understated income, combined with the taxpayer's failure to offer a reasonable explanation. On the flip side, overstated deductions or credits. Are you claiming credits you're not entitled to, such as the employee retention credit, the ERC? You probably heard those commercials on the radio. They're saying you'll get $26,000 as an employee. Well, is that true? Do you qualify? Well, that's a good question, right? So if you're claiming credits that you're not eligible for, that's a problem. Claiming clearly improper, exaggerated amounts, unsubstantiated by facts or documentation. Using deduction descriptions in such a manner as to conceal the true nature of the deduction. Stuffing personal expenses under supplies or stuffing personal expenses in your meals expense. What if it's a personal meal? It's not a business meal. You can't deduct that. Or mileage that's personal. That's commuting. You can't deduct commuting mileage. So some people get a little bit too creative and hide certain expenses and numbers. So cheating just doesn't work. Or failure to explain items questioned by the service, the Internal Revenue Service. Sometimes some taxpayers just can't seem to answer those questions. So make sure you be able to explain the items on your tax return. Okay, there's negligence and there's fraud. Fraud is really bad. Why is fraud bad? Well, the statute of limitations gets extended. General statute of limitations is 3 years. The IRS has 3 years to audit you. However, if you suspect fraud, that could be a lot longer. It could be 6 years, 7 years, or even more. That's really bad. Fraud, it's always intentional. You have intent to evade taxes. You have false explanations regarding understated or omitted income. There's large discrepancies between actual and reported deductions. Not good. Concealment of income sources. There's numerous errors. They're all in the taxpayer's favor. You have fictitious records or other deceptions. No, you shouldn't have more than 2 sets of books, right? Or 2 sets of books. You have one for the IRS, you have one for the bank. That's not going to fly. Large omissions of personal service income, false deductions, exemptions, and credits, failure to keep or furnish records, incomplete information given to the return preparer. Sometimes tax preparers don't know about certain things because you didn't tell them, and they can't read your minds. Large and frequent cash dealings. That's where there's a lot of fraud when it comes to cash. Verbal misrepresentations of the facts and circumstances. So at the end of the audit, you can have 3 conclusions. It could be no change, which is here's your tax return, no change. The numbers are fine, no change. Or you do, made a mistake or they made an adjustment or so, but you agree to it. You can have agreed to the audit. Okay, I owe $1,000 or I owe $10,000 or whatever, but you agree to it, close the case, you're done. You disagree, you don't agree with them. They say you owe a certain amount, you disagree. You say, I disagree with you based on the law. I disagree with you based on the information provided or something like that. If you disagree, there's different ways you can go. You can go with a group manager review. You can schedule an appointment with the group manager, discuss disputed issues, attempt to get the issues resolved. You have documentation. Maybe the agent ignored it for some reason or didn't understand it. Obtain agreement, and this will help limit the taxpayer burden. So group manager review is certainly an avenue to consider. Other resolution options include what's called a fast track settlement, FTS, if you're eligible for that. Or you can file a formal appeal with the Office of Appeals. This is a separate organization of the IRS. They're outside of the examination people. So they're kind of like a judge in a way. That's through the Office of Appeals. Or you can pay the deficiency and then file a claim for refund. You're basically suing the U.S. government to get a refund. You paid it, but you're suing for the refund. And this is the reason why we're suing. Or you receive a notice of deficiency and file a petition in the United States tax court. If you want to go with the tax court, you don't have to pay the tax due. You just explain to the tax court judge why you're correct. You have to have a legal basis and a factual basis. So these are your different resolution options. The fast track settlement program, it helps expedite case resolution. It's a voluntary mediation program, and it can resolve a tax dispute more quickly than a traditional appeal. And the IRS appeals officers are very busy, so that might take them some time. Appeals mediator will facilitate the settlement discussions. They're the third party. Since it's voluntary, the appeals mediator cannot force the taxpayer or the IRS to participate or accept a proposed agreement. They can't force it. And if you're unable to resolve a dispute through fast track, you still have a right to request a traditional appeal or conference with an IRS manager. The goal is to resolve cases within 60 days of the fast track application acceptance. So you can go to publication 5022, Fast Track Settlement, a process for prompt resolution of small business and self-employed tax issues. So the booklet that talks about this program. To get the fast track settlement process going, you file form 14017, application for fast track settlement. This has been around since 2017, so you get more details at Revenue Procedure 2017-25. But what's the best way to avoid an IRS audit? I think trying your best to avoid an audit would be a good thing, right? Well, fill out all the tax forms completely. Don't skip any of the questions. On Schedule C, page 2, in the middle of the page 2 of Schedule C, there's questions about your business vehicle. A lot of people leave those questions unanswered. Answer those. Or if you're claiming the earned income tax credit or the child tax credit, there's some due diligence questions that you need to answer. So you make sure you answer those questions. So there's a reason why they're there. File your tax returns on time. File them late could trigger an audit because they're late. Keep good records, have a good system, be diligent about that. For example, you're selling your house. Well, you need to figure out what the cost basis is. So hopefully you have a spreadsheet that calculates the cost basis, and that kind of backs up the information. Don't lie. Lying is not helpful. We can always figure out that you're lying. It's easy to figure out if you're lying, because we can verify the information you provide. So don't lie. Not a good idea. Report all your income. report all your income, not just the forms 1099, the 1099 miscellaneous, 1099 NEC, your 1099 DIV, your 1099Bs. Don't skip that. More importantly, understand the tax rules. They're changing all the time. They could be changing in what's deductible, what's not deductible, or how much is deducted. So understand that. Understand the rules for claiming business losses. Are you subject to any limitations? So you have to know what the rules are. Now, what are the hot topics that the IRS is auditing? Well, charitable contribution, Schedule A. If you have non-cash, that's Form 8283. Read the instructions. There's been people with cases where they lost millions of dollars of charitable deductions because they didn't follow the rules. Recently, there was a case of someone who claimed a $3 million deduction for donating stock to a charity. Nothing wrong with doing that. However, they didn't follow the steps to claim that deduction correctly. They lost that $3 million deduction. So again, it's important to know the rules and read the instructions on the form. Math errors. Yes, there are math errors. Even if you use a computer, there are math errors. Basis of assets sold. You sell your house, you sell a piece of real estate. Don't make up those numbers, or you're selling a stock. A lot of the brokerages are reporting the basis of the security sold. So take a look at that. So loss limitations. Understand the loss limitations. There's different layers of loss limitations. Passive losses, basis in your partnership. That's really important. Basis in your S corporation, Form 7203. Make sure you file Form 7203. If you don't do that and you have an S corporation, you're getting an audit. You got to understand the S corporation rules. I know many of you do have S corporations, and I've been hearing some of you talk about them. And I'm a little concerned. About your S corporations. You might not be following the rules. It's a target of audits from the IRS. So make sure you understand S corp rules. The big item S corporations, not only the basis, Form 7203, also reasonable compensation. If you're reporting a small amount of income W-2, but a large distribution on the K-1, that will trigger an audit. So you got to watch out for that. Tax credits, child tax credits, earned income tax credits, the electric vehicle credits, the solar energy credits, the clean energy credits. Make sure you're following the rules and claiming those credits. Are you claiming the right amount? Are you claiming too much? The IRS knows what it costs to put solar panels on the house. If the number looks too high, they will certainly question it. So watch out for that. Home office deductions. Make sure you qualify, follow the rules. Are you using the actual expense method or the simplified method? So home office deductions are an item that's looking at. Business mileage. Do you have documentation for your business mileage? And travel. So take a look at that. So these are the hot items of an IRS audit. So thank you for your time today. I hope this was helpful. And I love talking about tax. So if there are other topics you'd like to see, let me know. I'd be happy to put a presentation together and help you succeed. And that's very important. So thank you for your time, and have a good day. Thank you very much. Good day. Bye-bye.